Thanks for tuning into the earnings conversation of Tata Steel Quarter 1 numbers. Overall, lower volume deliveries and possibly higher coking coal inventory prices led to underperformance in the quarter, though you have to admit that relative to what was estimated on almost all line items, they've done slightly better than that. Mr. TV Narendran joins in to talk about arguably what could be expected in the year ahead, which is at the very least volatile. Mr. Narendran, great having you. Thanks for taking the time out.
Thanks, Neeraj, for having me on this.
Just a quick one on the quarter, because I believe these planned shutdowns, etc., all of that led to the performance that it did. It's better than the Bloomberg estimates. You would have hoped for something better, or is this in line with what you had penciled in?
No, I think we started the year not expecting it to be such a challenging quarter, simply because we had expected a better recovery in China. That had not happened. And so as a consequence, international prices stayed quite low, and that is reflected in domestic steel prices also, I think, and also prices in Europe. So I think to that extent, things have been a bit soft. We've not yet had the benefit of lower coking coal prices. Coking coal prices dropped, but you will see the benefit in Q2, because in Q1 we were using the coke that we bought in Q4 of last year, right? So the cost has not flown through as much as we had done, not as much as we'd anticipated. It was obvious that it would flow through only in Q2 and not in Q1. Demand in India has been quite reasonable. Auto has been strong. Construction, we had expected better, but not too bad. But because the sentiments were a bit weak, people started postponing purchases whenever they could, so that's why maybe the, kind of the consumption which was demonstrated was probably not reflective of the real consumption. People were trying to postpone consumption as much as possible. So this is what happened. In Europe, of course, we knew that we would have a tough 2 quarters, because in Netherlands, one of the 2 blast furnaces have been taken down for a relining. So it's a 5 to 6 month kind of job, and which is going on. So we had guided that Q1 and Q2 will be challenging in Netherlands. UK is reflective more of the overall steel prices. Inflation has been high in Europe, and interest rates are continuing to go up. So macroeconomically, Europe is slightly better than it was last year, but still nowhere close to where it used to be before Russia and Ukraine had this conflict.
And I would guess, Mr. Narendran, it's almost impossible to try and pencil in whether recovery in Europe at least comes in Q2 or Q3 or beyond that, as things stand.
So in Netherlands, you will certainly see a much better H2 than H1, simply because the blast furnace will be back, will be back to the full production. So that itself will have a huge impact. And Netherlands always has been a cash positive, EBITDA positive business. So we should be back to that. And UK is where we've had challenges. In UK, we continue to do a lot of work to see how to optimize on costs, cut down on the bleed. But more importantly, we are in conversation with the government to find a long-term and sustainable solution. I think we are coming close to reaching some conclusion over the next few months. And that will help us plan the way forward for UK.
But I reckon, therefore, Europe in second quarter as well, not too much should be anticipated by the street, as far as Europe goes at least.
Absolutely, because Netherlands blast furnace will anyway be down in Q2, and I don't see the economic conditions improving dramatically in the next 2-3 months.
Got it. Now, maybe too early to assess, but instead of a full-blown stimulus, at least the Politburo, Chinese Politburo signals some support for the real estate sector. Tell us, how do you read into this? Is this a good enough stimulus for steel, or would you reckon that something better would be needed?
So obviously it's helped, but not enough. Okay, so what it has done is the stimulus has gone towards completion of incomplete projects. The new starts are still much lower in China, significantly lower than it was last year, maybe 20% lower, right? So if you look at it, it's just gone to fix the problem of incomplete projects. And the optimism which needs to be there to start new projects is not yet there in China. And construction drives 60% of the demand. So while auto has been strong, construction has not really taken off. China is also making a pivot to more a consumption-led growth than investment-led growth, whereas India was traditionally consumption-led growth and is pivoting more towards investment-led growth. China is pivoting away from investment-led growth more to consumption-led growth, because their debt on the Chinese balance sheet is also quite high, and hence they're trying to see, can they have a more sustainable growth. So I think we should get used to lower growth in China than we've seen in the past. Maybe less steel-intensive growth if it's consumption-led growth rather than investment-led growth. And India hopefully will see more steel-intensive growth.
In which case, Mr. Narendran, if this is the policy that continues, would you reckon that the earlier drift that the market has of China being the key driver for Indian steel as well could change in some fashion, if not completely, over the next 12 to 24 months?
Certainly it could. Because one thing which is happening in China is, at least for most of the last 5 years, they have not been aggressive exporters. So after 2016, China has never exported 8 million tons a month, which it has done in the last 3 months. Okay, but I think that's more a fallout of the fact that the Chinese steel industry produced more in the Jan-March quarter, expecting the economy would take off. It didn't. And already we are seeing exports drop from 8 million to 7 million. And if it comes down to 5 to 6 million level, which it has been for most of the last 5-6 years, steel prices will settle between $600 and $700, which is where it normally lies when China is exporting 5 million tons a month. So I think we are seeing a little bit of this correction going on in China, because China is very clear that they don't want to be a big exporter of steel, because they also have very aggressive carbon footprint targets, and they don't want to be importing iron ore and exporting steel and leaving a carbon footprint behind. So I see this correction happening. India demand growth to be strong, and things will balance out, and that's why I feel that H2 will be much better than H1.
Okay, last couple of questions. One is, 2 days ago, Japan Steel gave out a fairly strong performance and commentary about capital spending. Would you reckon that would be restricted to what's happening in Japan and therefore not symptomatic of what could happen to Asian steel by and large, or not quite?
So I think if you look at what's happening in Japan, China, etc., there's a lot of work going on locally. But at the same time, as far as the steel industry is concerned, there's a lot of interest in Southeast Asia, which is a big importer of Japanese, Korean, and Chinese steel. So you see a lot of Japanese projects, Chinese projects in Southeast Asia. And the expectation is that instead of exporting steel to those countries, they will have projects there which will make steel locally and consume it locally. As far as Japan is concerned, I think they've also been a bit spooked by the yen. The yen weakened quite a bit over the last few weeks now. I think it's settled again. Good news for Japan is, I think inflation is good news in Japan, because for a long time they've operated in a very deflationary kind of environment. But Japan is fundamentally resilient because they have their own savings to take care of the investments that they need to make.
Sure. So if I want to pencil in and try and figure what TISCO does over the next, say, 3 quarters, 4 quarters, would you suggest that I squarely look at what's happening within the Indian landscape, because the Indian demand seems to be strong and that drives what happens to overall Tata Steel's performance?
Yeah. So as you know, we have very deliberatively grown the India business, right?
Right.
So the India business has doubled in the last 10 years, and we hope to double it again in the next 10 years, right? That really makes us more dependent on what happens in India. And even in India, if you look at it, we actually sell in India 90% of what we produce, if not more, because we have a very strong domestic franchise, both retail, the OEM, auto, oil and gas, pretty much all high-end segments, we have a very good and high market share. So our whole strategy is about growing the India business, and we are very strongly committed, and we believe that the India story will be very strong. Like I said, it's moving to investment-led growth, which is going to be more steel intensive. And we have a strong position in the domestic market, well integrated from upstream to downstream. So we want to leverage that. As we fix the issues in Europe, we want to make India a bigger and bigger part of the business, so that even if you have a problem in UK, today it's 10% of our business, whereas earlier it used to be 40% of our business. Right? So the impact it has on the overall Tata Steel bottom line is less than it used to have maybe 10 years ago.
Got it. My final question, slightly short term, actually very short term, Mr. Narendran, and that is Q2. You've given us the macro. Just one quick word on the inventory piece as well. If that comes off, I mean, the high coal inventory, which you kind of spoke about, is that good enough to lift the operational metrics in a meaningful way? Or would the demand pressures across the world still play a spoil sport in Q2, and we see H2 as the real big shift away from what's happening right now?
I would think H2 would be a bigger shift than Q2 to Q1. In Q2, what will happen is we are seeing realizations will be about 3,000 to 3,200 rupees lower per ton in India in Q2 compared to Q1 because of the way prices are today. I think we've hit the bottom as far as flat products is concerned. In Europe, it will be about 40 euros per ton lower in Q2 than Q1. And on the flip side, the costs will come down by at least $50 a ton of coking coal costs. So, you'll have the prices going down, costs going down, EBITDA is, in that range if you take out the one-offs. But demand is okay. I think we don't have a problem selling what we produce. So there won't be an inventory buildup. But H2 is when we see one is in Europe, we'll be back to two blast furnaces in Netherlands. We'll see lower energy costs and gas prices playing out. And we'll see the benefits of, hopefully better international prices as China exports.
Got it. We're done with time. We'll take the CapEx comments from the con call. Mr. Narendran, thank you so much for taking the time out and speaking to us today.
Thank you. Thank you very much.
The pleasure is ours. Viewers, thanks for tuning in.